going to go ahead and show my screen, get this stuff out of the way so you can see everything. A couple of items to cover first. We're recording this webinar as we usually do, and as such, everybody is on mute. If you got any questions during the course of the presentation, you can type them in the chat feature, and David will do his best to get them answered during the presentation. We will open things up at the end of the presentation. We'll have a full Q&A. Again, that's what we normally do here, and we're going to spend the next 40 minutes or so and talk about long-term care, why it still matters, what this 101 million reasons why it matters, what that's about, and just try to give you, kind of reorient you, reset your thinking, and get you moving forward, hopefully, with what we still believe is a fantastic opportunity. So I want to start with a story. A few weeks ago, I was traveling on business on a trip, and I was flying and had just settled into my airline seat, and a guy plopped down next to me just a couple minutes later, and he was kind of looking frayed, a little scattered, if you will, and we exchanged some small talk for a while, and happened to get a look at his business card, and the business card said that he was an agent for a big life insurance company, and didn't take me very long when I saw that to grab my book and plop my Dr. Dre headphones onto my head and jump into the middle of that. And there's a reason that I'm sharing that story for you here real quick, and we'll circle back to that in a little while. Hang on, we got a question right out of the gate here that I'm sure is just earth-shattering, so give me 1 second. Let me see if I can cover this real quick. Okay, not really a question, so we'll skip back to where we were. Sorry about that. I was just concerned that maybe there was a technical issue that we hadn't gotten covered. So we'll go back. So anyway, we're going to talk about, as I said, why long-term care matters and how it relates to the American dream. And the concept of the American dream was first introduced a number of years ago. And if I threw that question out to everybody that's in the audience, and we got a decent-sized crowd, and I know there's some late joiners here, I'd probably get as many different answers about what it means as we have folks on the call. And a guy named John Truslow Adams coined the phrase many years ago. And as we all sort of craft our own version of what it means, I think, regardless of the differences, we can agree that what it doesn't mean is that we're going to work hard and save like crazy for 40 years and then watch as that money gets used to pay for health care after we retire. And I think you'd agree as you think about what that long-term care, not long-term care, but what that American dream means, as you think about what it means, it probably involves a comfortable, event-filled retirement. That's got to be a big part of it. I know it is for me. But the truth of the matter is that with all that work that you're going through, whether you are an employee or an independent contractor and it's 401ks or 403bs or IRAs or whatever, okay, the people in the workforce, only 10% of those people have actively taken steps to protect themselves. All right. So as we go through our time together today, I want you to ask yourself some questions as we get set up. Do you consider yourself to be a long-term care specialist? I'm sure there's probably some of you out there that do property casualty work primarily, or maybe you're a CPA or a financial advisor even. The point is that when I talk to a group of agents like this, there's a diverse group of people. A lot of times we'll start, if we're in a face-to-face situation, we'll start and have everybody kind of raise their hands in those different areas. The nature of brokerage, which is what we're all in the middle of, is that we don't all focus on the same thing. The simple truth is that our customers are probably as likely to have different profiles, but we know that you're here today because you want to learn about something new that piqued your interest, and we're glad that you've taken that time. So as we go through, I'm going to try to speak to all of you. You're going to perceive the problem to be different depending on what your orientation is, and I'm going to try to approach it with that in mind. If you hear me saying something that you don't really think resonates with you or doesn't apply to you, it's probably because I'm trying to make a conscious effort to talk to another part of this group. All right, but believe me, we will circle back to you and what it is that you do. Along the way, you're probably going to see me being a little bit of a drill sergeant, maybe a little bit of a coach, a little bit of a teacher, possibly even a little bit of a spiritual advisor. So self-survey 2, how many of you sold long-term care in the last year? Just think about it for yourself. How many of you sold long-term care in the last month? It's what we do, so that's why we ask. How many of you used to sell long-term care actively and gravitated away to other markets? So within our group here today, we've got people who are actively or self-acknowledge that they're actively in the market, people that used to be in it, probably some people that want to be in it. And regardless of which of those groups you're in, you came here for a reason. Okay, so I guess I'd say let me welcome you back to the long-term care conversation. If you were away for a while, we're glad you're here. In the next few minutes, we're going to show you some new things, talk about some different things, and then at the end, it's going to be time to step out. All right, if you're one of our serial webinar attendees, and we know who you are, ask yourself what's holding you back, because we're going to put some of what I think are the final pieces in place today to help you go forward and have a new conversation with a new type of prospect. All right. And that sets a stage for kind of where we're at right now. For those of you that are in long-term care, and those of you left, I'm not going to spend a lot of time hashing over the negativity of the past. Things have changed a lot. I'm not going to tell you that we've been able to solve all the problems that we had to deal with along the way. The truth is we've got a pretty good handle on most of them. We're really down to one. We've got some ideas on that one that you'll see us talk about here a little bit later. We've been doing this. We've been talking to agents for 40 years. And along the way, especially in the last few years, the market that we work in has contracted. We could show you the number of agents we used to talk to, huge numbers, and the number of companies that used to be in this business. But that's negativity. And when we do that kind of thing, people tend to get defensive. But the truth is, there's some advantages to that contraction. There's some advantages to where we are now. You've got fewer carriers to have to be aware of. We have a better and much more diverse product set, very advantageous. And right now, the rates appear to be about as stable as they've ever been. And as we have this conversation, keep in mind, there is no one solution that's perfect for everybody. So don't get defensive if you feel like we're not talking about what you do. That's not what we're doing here, okay? And regardless of what it is that you feel like you do, we're here to show you a way to be more comfortable and effective. And that's regardless of which products you utilize, whether it's traditional long-term care or one of the new alternatives. And contrary to probably things that you've heard or maybe even said, the market's huge, gigantic. Okay, there's a purpose here. And through all of this, AIM is still here. There truly is no greater proponent of long-term care, primarily traditional long-term care, but of long-term care than AIM. And we have been that proponent for a long time. But another truth, you hear me talk about a lot of different truths and mini truths, if you will. The truth is it's probably time to adapt. It's probably time to get comfortable with a new type of conversation, and we'll have some ideas for that for you here in a little bit, and embrace the need for a new type of product because our job has evolved. It is now about protecting that American dream. And another harsh, simple truth is if we as an industry and as all of us as individuals, if we do not step up, people we know personally will be hurt by our inactivity. We hope that what we're going to show you today is going to help you work smarter and improve your odds. You know, are we going to be able to get 70-year-olds approved? Probably not, but you can keep trying if you want, like some of the old dogs do. Or you can change your orientation and work with the 45 and 50-year-old prospects who are healthy enough and financially suitable enough to get themselves approved. Your orientation's up to you, but it should be pretty obvious to everybody that your issue rate and your success rate will improve if you adapt what you're doing to deal with some different prospects. If you come back to long-term care into this market with an open mind and try a different way to sell to different products, you're going to win. Everybody will win. And like Bruce Springsteen says, nobody wins unless everybody wins. The clients you're going to talk to, the prospects, on average, they're going to spend about $2,600 each. That number hasn't really changed. One of the things we've got to come to terms with is that they're going to get less coverage for that number. It's just reality. But if you work smarter, not only are you going to thrive, but you're going to succeed within those parameters. Now, a couple of minutes ago, I said that if we didn't step up, people that we know personally are going to get hurt. And I know this to be a truth because part of what I don't do is sell. I'm a wholesaler. I'm licensed, but I work solely as a wholesaler. And my closest friend last year had a stroke. This is a guy I have known for 40 years. He had a stroke at the age of 63, and he ended up financially devastated as a result of that. And as I said, I don't sell, but every time I meet with this guy, and we do spend a fair amount of time together, I can't help but wonder every time we get together that if I had done something a little bit different, if I had spent some time talking with him and his wife about how long-term care might help them, that I'd have been able to help change the financial devastation part of that outcome. And if you saw this guy, you would say there's no way he's a stroke risk. This guy is 6 foot tall. He weighs 195 pounds. He had the stroke sitting on a bench in the exercise room in his house. He was trying to tie his shoes. Okay, so we're not talking about a guy that's sitting there eating jelly donuts or any of those kinds of things. He does not look like a stroke risk. Okay, and that's really the most stark, hard truth of this conversation today is the cost of long-term care, which is devastating. It's the #1 threat to retirement planning in middle America. That's why we talk about protecting the American dream. Okay, that's us. Middle America is us. We are protecting those folks. And the gravity of the situation now is bigger than it's ever been. And you'll notice that I've got this foreclosure sign up here, and you're thinking to yourself probably, what the hell does foreclosure have to do with long-term care in this American dream? Well, when people retire, they've got money set aside for a lot of different things. Okay, if they haven't protected that, money that they might have allocated for a house payment is going to have to go towards care. One of the things that my buddy, his name is Scott, one of the things that they had to do when they liquidated their 401k is they had to pay off their house, and they had to pay off a car because he's a single breadwinner in the family, and by losing his income, they weren't going to have enough money coming in every month to cover the cost of that house. And they're not alone. A lot of people go into retirement in the new lifestyle that we've chosen here with house payments that are still active for them. They didn't buy a house and pay for it cash, or when they built their dream, or they got their dream house, they bought it, they financed it, so they're still paying for that along the way. You take that and then you add in it's a $7 trillion problem, rough numbers, and I base that on the fact that the average 401k balance in this country right now is about $96,000. And if you look around, you can find a little bit higher number, a little bit lower number, but that's workable for our conversation. And if you remember at the very beginning, I talked about 101 million reasons why we do what we do. That's the number of people in the workplace today who have not taken any steps to protect their American dream. This is a serious problem. If you want prospects, this is a stack of prospects that is going to keep all of us busy until we retire, as busy as we want to be. Okay? There's a lot that's been said about the long-term care market in the last 10 years, but it's pretty obvious from that number right here that the market did not shrink. Okay? It stalled. You could ask yourself why it stalled, and you probably point to a lot of different reasons. Okay, and a couple of them, and we'll talk about those a little bit more down the road center around this idea of stalling. So ask yourself along the way, because the truth is having this conversation is a little bit difficult. Did our industry let America down? Okay. Americans are used to difficult and complex financial transactions, but it seemed as though for a period of time, knowing that this prospect pool is largely the same numbers, a little bit bigger, but still there, the industry turned away when these people needed us the most. And that's why we're challenging people to reorient, reconsider things. And as we go along, as you'll see in the next few minutes, you're going to need to reconsider most of what you say when you have these conversations, and a lot of the questions that you ask folks. This new type of prospect that I alluded to get access to them, it's not going to require you to spend a ton of money. You're not going to have to buy leads. They're there. In fact, you don't have to spend any money. You got plenty of people to talk to. So it's really true that you picked a great time to decide you wanted to move back in this direction. And you can do this. You got people to talk to. We're going to help you develop a new skill set and a new conversation that you're going to have to thrive in this market. It's brokerage. The 90-10 rule applies to a lot of these things. But when we finish today, some of you, and that's part of this 90-10 rule, you're going to go forth and you're going to make an impact on the problem. Others of you are going to choose to go forth and do other things. That is a personal choice that you make. We are convinced that if you really care about helping people, and that's what we do in the insurance business, we help people, and you commit to making some changes to how you do what you do, okay, you're going to have an impact. You're going to have an impact in your bottom line. You're going to have an impact on the financial well-being and safety of these prospects and clients that you have, but it is going to require, in a lot of situations, that you step out of your comfort zone and get moving. It's not going to necessarily be easy, but it can be done. Is there an opportunity here? Hell yes. Do people need our help? Undoubtedly. So the first thing I want you to think about is reorienting yourself mentally and focus on the idea of risk management. So think about that for a second. If you remember at the open this morning, I talked about diving into my headset when I was seated on a plane next to the New York Life agent. Do you think possibly that's how some folks that you want to have an insurance conversation with, how they feel when they know that this is air quotes, the insurance person is coming over? Just think about that for a minute. If you, and we will have follow-up sessions specifically on this, but when you ease into an introductory conversation and tell your prospects that you specialize in risk management, the truth is you're a licensed insurance agent, but your specialty is risk management, and that you work with, and that as you have worked with people, you are alarmed at how many of them are absolutely, totally unaware of the exposure that their retirement plan currently faces, okay? Long-term care is the biggest unsecured risk anybody in this country will ever face. Whether they know it or not, they are facing it. Everybody who is in the workforce and over the age of 40, who does not have a long-term care plan in place, whether they know it or not, this morning when they woke up, they are self-insuring. 100% self-insuring. So you sit down with them and you talk about risk management and how it works, and that's what you specialize in, and get them to understand how serious this is, okay? For somebody who's got that $96,000 average long-term care balance, if they have an event that lasts 1 year, that money is all gone. Based on what we know, a married couple in their 40s or 50s, they're looking right now in today's numbers at about $500,000. That's well more than enough to wipe out the average 401k balance for a worker that lives in this country. It's enough to wipe that balance out 4 times over. Okay, and these people, as I told you before, there's about 100 million of them or so. they've got a massive problem at on their hands that they don't even know about. It's coming right, and people are ending up financially devastated every day. People like my friend Scott. All right, we have a chance to help them do something, but it's got to start by having the conversation. And that conversation is going to be about a new way to proceed, both for you and for them. There are new solutions to this situation. It's not just traditional anymore. Traditional is very high leverage, but as you'll see here in the next few minutes, we know that there are people who don't care for the value proposition of traditional long-term care. Right? And we need this diversity because we're now aware of this information, and you'll see more about that very shortly. If you've sold long-term care before, you know that people have a problem with that product, but they may not tell you what their problem is, okay? You know that when you walk out of a home without a check that something's wrong, and you're not talking about people that financially qualify. We're talking about people who can, and they choose not to buy. So why is that? Maybe it's because they're looking for something that's guaranteed. Maybe they don't like the idea of the use it or lose it proposition, okay? Life Plans did a survey about 1.5 years ago. They surveyed buyers and non-buyers of long-term care. It's got some fascinating scientific, non-anecdotal information. And what they found out was that 86% of the people that did not buy long-term care said they would have been more likely to engage in that transaction if they could be certain that their premiums would not increase. Guaranteed. 67% of those people said they would have been more willing to engage if they could be absolutely certain they would get something for an investment that they saw as a considerable investment. Translation, they don't want a use it or lose it product, which is what traditional long-term care is. So these things are telling us something about the risk tolerance that exists today, something that perhaps we ignored previously. So you're going to see here in a little bit, one of the new options that we've got very specifically addresses these issues. But to make sure that we address them, we've got to be listening for the verbal cues that point us towards this new idea of risk sensitivity. It's pretty obvious that the way we deal with risk sensitivity is to help them find a new way to manage that risk. So ask yourself, and you know, this feedback that we just got, are we really listening to it? These are scientific numbers. This is a survey that meets, scientific survey parameters. Very, very powerful feedback from people that didn't transact. And it's feedback that's less than a year old. These people are telling us huge numbers that they opted not to engage because they want guaranteed pricing. Okay? They are also telling us that they want to be certain they're going to get something for an expense that they consider significant. So we got to figure out how to find out whether these people are risk averse, like the ones we just talked about, or risk tolerant. We're going to have to find out some new questions, and we're going to talk about that here in the next few minutes. And that will enable you to make an appropriate product recommendation. All right? So as we specifically address these things, continue to focus on managing that risk, you're going to be asking yourself, all right, how do I present this to them? Well, we're going to give you a couple prop ideas here. And I've worked with some agents who have had success with this. So you're going to need to make a small investment. Go down and get yourself a nice, crisp $1 bill from the bank and keep it for just this purpose in an envelope and throw a penny in there as well. And the reason you're going to do that is that when you start the conversation with your clients, in front of your left hand, you're going to put the penny down, and in front of your right hand, you're going to put the dollar down, and you're going to let them sit there. And a lot of us are students of human nature, and believe me when I tell you this is going to drive them crazy. Not knowing what this is about will engage them. and you continue to talk about how you work to manage risk, and you talk about you're working with people who don't even know that they have this risk. So you ask them, about your cars. You see cars in the driveway, or if they have a garage, they're in the garage. What year are they? Did they buy them new? Who do they have them insured by? You're sitting in their home in a lot of cases. Nice home. When did they buy it? Has it appreciated in value? Talk about homeowners insurance and how it's kind of a pain in the butt a little bit because you have to figure out replacement costs and all these kinds of things. They're engaging in a conversation with you. That home is the second biggest asset they've got besides that retirement plan. In today's environment, you can talk about health insurance. Do they have it through an employer? Are they paying for it themselves? Provides coverage if they have surgery, these kinds of things. It begins to engage them with you in this whole risk management idea. It's what you do, and it encompasses a lot of different things. That house, they may think it's their biggest asset, but they should probably question that, because by the time they retire, the plan they've put together for retirement for both of them is probably going to be worth more than that house. The likelihood is they're going to nod their head when you're having this conversation with them, and then you ask them, so who's insuring that 401k plan or whatever the retirement plan that they've got is, because they're feverishly putting money in it to be positioned in a way that they are, and you saw that cushy little golden egg in the nest and that kind of thing. Do they understand that that retirement plan is serving two functions right now? In the event that they have a sudden need for care, that also is their long-term care plan. And they don't have to agree with you, but we didn't make these rules up. These are the rules of the game, plain and simple, for more than 100 million people. So when you talk about risk management, the good part is you've got a solution. You've got a number of companies that you work with who specialize in warehousing risk. So there is a solution for most of the folks that you're going to talk to, and the reality is that solution involves a penny and a dollar. You can work with them and put together a solution where they can offload the greatest amount of that risk for about a penny on the dollar, or they can choose to continue to self-insure for a dollar on the dollar. And when your meeting with them concludes, they're going to make a choice, and they're going to keep making a choice, conscious or not, every day. And that choice is, do they want to transfer that risk to a company that specializes in dealing with that for about a penny on the dollar, or do they want to not take any action, still making a choice, but not taking any action, and face the possibility of paying 100 cents on the dollar if something goes wrong? Because when you really boil it down, it starts with the idea of a dollar on the dollar, but right out of the chute, you're going to whack about a third of it out, because when they have to use that retirement money to fund long-term care, the first thing they get to deal with is taxes, early withdrawal penalties in all likelihood. So that's going to knock about a third of that out of there. That radically changes how this works. And so while you were having the conversation with them earlier, you're trying to figure out where they sit with regard to risk, were they telling you about Uncle Louie and his Unum long-term care policy and the rate increases that he had to deal with, for example? Did they mention that they knew somebody who had a long-term care policy, but they died in a car accident at the age of 59? They never used it. These spontaneous comments that they make during the course of that conversation are valuable feedback for you in terms of determining where they fit in that risk tolerance equation and the concerns that they've got. And frankly, you may have to go more direct. You may have to ask them about anybody in their family ever needing long-term care, how things got handled. Do they ever know anybody who owned long-term care? And the reason this all matters goes back to that survey that I talked about, that 86% that didn't engage because premiums weren't guaranteed, and the 67% that had an issue with the use it or lose it. They may be telling you without self-identifying that the traditional solution is not going to work for them, or that they have a higher degree of risk sensitivity. But you've got a new solution because the problem is still largely the same. But how you go about solving it is based on different parameters than it was before. For a lot of you, it's going to be a better solution than you've seen before. Everything's guaranteed, the premiums, the benefits, the whole 9 yards. Okay, and the beauty of it is that 2 solutions are better than 1. Traditional is still there, but hybrids have begun to catch up fast. And hybrids, for the most part, address the reasons that a lot of consumers, and you saw the numbers a few minutes ago, why they have chosen not to purchase previously. Okay, the reason we need a new solution is because not everybody that's buying, not everybody was buying what we were selling, and success in the year 2017 looks a lot different than it did in the year 2005. We don't have 20 carriers, like I said before, in one product. We've got a few carriers with multiple products. And we acknowledged before that none of the solutions that we've got are the absolute right solution for every person that you're going to have a conversation with. Okay? A lot of the reasons that agents left the long-term care marketplace had to do with complicated products. And I'm going to give you a disclaimer right here. There's a lot of stuff that's in this hybrid space. Okay, we're going to talk about one thing, but there's a lot of it that's out there. Okay, over the years, we had access to it, and we didn't do much with it. Our agents didn't do much with it. And when we sort of did a post-mortem on that initiative, we realized it was too damn complicated. The agents couldn't do anything with it because they couldn't wrap their head around presenting it. What you're going to see today, and some of you may have seen it before, some of our serial webinar attendees, what we're going to talk about is one solution that we really like that's really, really easy. That was a big consideration for us when we were looking for a new alternative to the traditional option, something that would round out the portfolio and that was going to allow agents to have access to an easy to understand second solution. And that brought us to CareShield from Minnesota Life. Doesn't get any easier than this. I tell agents every day, if you cannot explain this on a Post-it note or a cocktail napkin, you've overcomplicated it. I sat in a breakfast meeting a couple of months ago with an agent that works a lot in the hybrid space and candidly favors a different hybrid, and probably took 70 words for this agent to explain why they felt like that was a great opportunity for their clients. The truth is, you can explain CareShield 10 words, and you'll see those in the next couple minutes. Guaranteed premiums, guaranteed benefits, guaranteed ROP. That's it. So I guess that's 7. We boiled it down to the 7-word solution. All right? So CareShield, it pays if your client needs chronic care. All right? They can have a monthly benefit of between $2,000 and $10,000 a month. Pays out over a 25-month period of time. Cash benefit, no receipts required. You meet the 206 ADL or cognitive requirement, those benefits can be used any way the client chooses. It also pays if they don't need care. They have a death benefit available. The face amounts for the death benefit range from $50,000 up to $500,000. And they do have an option for terminal illness as well that accelerates. We're not going to get into those details. That's not what we do primarily. And ROP is guaranteed. So you got guaranteed premiums, guaranteed benefits, and guaranteed ROP. And again, most important, those premium rates are guaranteed for life. So in solving the problem, we got something you can draw up on a napkin. It's all guaranteed. Clients are going to know exactly what they're paying for and exactly what they're getting, and it's never going to change. So why do we think this is a better option? It's guaranteed. It may not be the perfect long-term care solution. I'm not sure that's ever been created yet to this point in time. But for many of these new clients that we are going to be having these conversations with, it's as close as it's going to get, and it is competitively priced. This is just one example, 57 female. The truth is you'll probably have as good a success under the age of 50 as you do over, and you can see how the premiums for this product stack up. Typically going to be looking at about $125,000 pool of money, roughly $4,000 to $5,000 monthly benefit. Okay, when you look at women, pricing is actually less expensive with this product than it is for traditional long-term care when you compare it to men, which is a nice break. When you talk about traditional, premiums are going to go up. We don't know when, we don't know how much, but we know that it's going to happen. It is a use it or lose it proposition, and there is no money back option. The things that these new prospects are telling us are concerns for them are the cornerstones of traditional. So maybe it's time to make sure that you've got a non-traditional option in your backpack, your portfolio, your briefcase, whatever it is you want to call it. We have a lot of folks that use the term another arrow in the quiver. However it is that you think it through in your mind, this is where you're set to go. So now, an idea for you on how to get yourself your first list of 25 prospects. And I told you that the best way was to start close, people that you know. Those are the people that you have as much of a vested interest in helping as anybody else. You just sit down and make a list. Everybody that you know, everybody that your spouse or partner or significant other knows. If you got a business partner that doesn't do long-term care, everybody that they know, and just start making phone calls and asking them, can you come in and sit down with them and talk about this risk management subspecialty that you have in your practice and how it applies to them. You just need about 20 minutes, 30 minutes of their time. You're certain it'll be worth their time, but you got to start with the conversation. It really can be that simple. So now I'm going to have Dave help me, and we're going to open this up for questions. So I guess, Dave, if you'll start at the bottom, I'll start at the top here. And we'll get everybody unmuted. If you're not going to ask a question, we would ask you to hit *6 on your phone and unmute yourself so that we don't get overrun with background noise. That does create a problem for us here when we record and when we try to get folks unmuted. Appreciate folks taking the time to unmute themselves. If you got questions, go ahead and fire away. We'd love to entertain them. Jan Walsh, looks like you got a question indicated out there. Go ahead. Jan?
Yes, is CareShield in all 50 states?
It's not in New York. It's not in California.
Oh, it's not in California. Okay.
They're working on it, but it sounds like you're an agent down there. You're familiar with how they're not an easy or quick process by any stretch of the imagination, unfortunately. And we'd love it if it was. We're doing everything we can, but got a lot of approval.
Hey, Bill Taylor, you had a question. You want to bring that up?
Yeah, I'm just typing it now, but basically, how difficult is the underwriting?
Let me take that, Mike. It's not a place to take a long-term care decline, put it that way. You are underwritten for both mortality and morbidity.
Right.
I won't say it's any easier than going for traditional long-term care. They do have table ratings available if it's necessary, given the health of your client, but definitely not a place you go if you think that your client is not going to qualify in the traditional side. But it's quick. Applicants under the age of 55, they do not order medical records. They just do a paramed or a phone interview. The underwriting guide, which we can make available to you, lays out based upon the age of the applicant and the face amount. It will tell you exactly in the underwriting guide what your client will go through during the underwriting process.
One of the things that I talked about earlier in the presentation, from a success standpoint and an issue rate standpoint, was to try to gravitate towards younger clients that are going to be healthier. You can work CareShield in the 60 to 65-year-old market. You're going to be more successful if you work CareShield in the 50 to 59 market. That decision is up to you. The truth of things are that the people that are in their 60s, they've had some sort of opportunity to take steps on this now. If they've got health issues, you know, that ship has sailed, whether it's traditional long-term care or whether it's something like CareShield or any one of these dozens of other products. So, you know, how much insanity you create for yourself, that's kind of up to you. I know we've got, let's see, we had another question here from Marion Bayham. Marion, go ahead.
Oh, can you hear me?
I can, go ahead.
Oh, okay. I guess the question is, does your CareShield include inflation protection?
It does not.
Okay.
Inflation protection is one of the things that drives pricing crazy in the traditional side. So Securian made a decision that they wanted to stay away from that.
Okay, so your example of comparing it to traditional isn't as accurate because the pool of money under traditional will increase with the 3% compound. Am I correct?
Sure, and you're also correct that the premiums will increase. We just don't know how much.
True. And then the other question is, I understand Minnesota Life does have a IUL that has a long-term care rider or agreement. How does this CareShield?
This is it right here.
Oh, this
No, they
is
have
it.
an IUL, Mike.
Oh, an IUL, right,
the,
yes.
Yeah, the Eclipse Protector, and that's a chronic illness rider as well. It's not a long-term care rider.
Okay. But it works like a long-term care agreement.
Yes, ma'am.
Yeah.
Okay.
Same
So
function.
And the Eclipse Protector is approved in California.
Right. But how does CareShield, is CareShield an actual IUL?
It's a GUL.
A GUL. Okay.
Yes. It's a lot
All right.
less complex. Hey, Ron
Okay.
Lewis, you had a question on post-claims underwriting. No, they do all the underwriting right up front. They do not underwrite at claim time.
Does it include a care coordinator?
So it's pure indemnity. So they're just going to
Oh.
write you a check. There's no accounting for how you spend the money or not or don't spend the money.
Okay, got it.
And you don't have to take the full 4%. So if you have a $6,000 monthly benefit and you really think you only need 4, then you just request the 4, and the 2 will stay in the pool of money, and the plan will pay out longer than 25 months.
How does this CareShield in states where it is available compared to Minnesota Life's Protector?
The Eclipse Protector.
Right.
They're two different animals. One's an IUL, one's a GUL. And so you have the complexities of the IUL. You have to pick your investment strategies and such. This CareShield product, as Mike mentioned, they dummied down the GUL. There's no moving parts to it. There's the illustration is only 12 pages as opposed to a normal life illustration, which is 30 pages. There's no cash value accumulation. So it's very, very, very simple product compared to especially compared to their IUL.
Oh, so there's no cash value.
No, they put everything toward the guarantees and the return of premium.
Oh, okay.
People that are buying this for long-term care purposes don't care about cash value. They're concerned about addressing the long-term care risk, the life benefit that comes as the second part of the not use it or lose it proposition is there as a bit of an add-on. So it's a little bit of a reverse. When the CareShield product became available, we were fully aware of Eclipse Protector. Great product, but it's a complicated product. We were focusing on this red button right here in the center of the screen because we had plenty of experience with our agents with a wide variety of other hybrid products out there that were complicated. Our agents didn't do well with them. They are doing phenomenally well with CareShield because you only need to know 7 words. You don't need to do investment strategies. You don't need to spend 30 minutes in a manual to talk about cash value and how it accumulates and where it's going to be. Guaranteed premiums, guaranteed benefits, guaranteed ROP.
So
It
does,
literally is that simple.
can you still hear me?
Yes, I can.
Okay, does CareShield have all the different modes of payment, including a single pay?
Yes.
No, there's no single pay
Oh, there's no
mode.
single. I'm sorry. You're right. That's why they brought the new IUL in. They just brought a brand new one in like a month ago, specifically to address the single pay.
Oh,
With
okay.
with the GUL, you have to be careful how much, when you do an illustration for CareShield, it will show you a dollar amount on there that if you make premium payments on an annual basis that exceed that dollar amount, you're running the risk of converting the contract into becoming a modified endowment contract. So it basically takes it away from being a life insurance policy altogether. So this is a continuous pay product only, and the rates are guaranteed age 120.
Okay,
And
thank
it
you.
also pays renewals. Yes. All right. Other questions out there this morning? Thank you for those, Marianne.
Welcome.
Remember, the max face amount is $500,000. The minimum is $50,000.
Good, I appreciate that.
Now, if you buy a $500,000 face amount, you're not going to have a $20,000 monthly benefit. They're going to cap the monthly benefit at whatever the monthly IRS allowed amount is. And this year it's $360, which equates out to $10,800. So if you bought a $500,000 face amount policy, your monthly benefit would be limited to $10,008. It would just pay out longer than 25 months, almost 4 years.
All right. Any other questions out there this morning? All good info.
Yes.
Two parts to this. The first part is to get out there and start having conversations with folks, and we recommend younger is better, which is a little bit different orientation than we've had before. And the second thing is be receptive to this idea that there's a different level of risk sensitivity than what we've worked with before. And I guess the third thing, I'll throw in a third bonus thing. Think easy. If you cannot explain it on a Post-it note, you've overcomplicated this, and you're probably going to have your clients spinning around in circles trying to keep up with all the different pieces parts. That's the reason that when we first saw this, that's the reason that we liked it, is because it was so easy. All right, any other questions before we wrap up here this morning?
Yeah, this is a life chassis. It's not a health chassis. It does not require the long-term care CE to sell it either. So keep that in mind. Premiums paid are not deductible on income taxes like you can with traditional long-term care if you're itemizing as well. I think that was another question that Mike had.
Okay.
That wraps it up, Mike.
Okay. Hey, thanks everybody. We appreciate your time. Keep your eyes peeled. We're going to have some other additional webinars. We're going to talk a lot more about the risk management conversation. We're going to talk a lot more about a lot of other things that are not necessarily product specific, they're concept specific to help support you going forth and having these conversations with these new prospects that you've got out there. So we appreciate you making your time available this morning. Dave and I are here at AIM if you've got additional questions on what we covered, and we will have the recorded webinar posted on our website later today. Thanks everybody. Have a great day.